Assalamu alaikum. Your Excellencies, ladies and gentlemen, esteemed guests, good morning. As part of the Federal Tax Authority commitment to provide a supportive tax environment for voluntary compliance, and as a Director of Taxpayer Services, my team mandate is to make sure every business and individual understands what they need under the corporate tax system, and that they have the right tools and support to do it easily. Today, our focus is on family foundations. Our goal is to help you clearly understand your responsibilities under the UAE corporate tax framework. We are always here to support you with the guidance and the information you need to stay compliant. The UAE corporate tax framework includes provisions for family foundations to support wealth management and succession planning. The FTA provides clear guidelines to help these entities understand their obligations. Family foundation in the UAE corporate tax law is not an entity type, but a tax concept. It refers to a foundation, trust, or similar entity used by families to manage and preserve wealth across generations. To qualify you as a family foundation for tax purposes, the entity must meet the conditions specified in Article 17(1) of the Corporate Tax Law. We encourage all family foundations to review their structure against official guidelines, use Imara tax for registrations, declarations, and submit required information. The FTA offers multiple channels for clarity: dedicated corporate tax guides, Imara tax portal for services, and the official FTA website, and various specialized workshops for awareness. In the end, our success is measured by yours. Whether you are a multinational business or an individual navigating our economic system, our message is clear. We are here to help, not just enforce. Thank you all, and hope you enjoy today's session. Thank you.
Thank you, Zahra Dahmani, for your insightful words. And now, I'm pleased to introduce our expert panel who will cover the key elements of the corporate tax law under Family Foundation. Please welcome to the stage Rida Hamzawi, Senior Tax Policy Expert, Zubair Chowdhury, Tax Policy Expert, Suraj Perm, Senior Tax Policy Specialist, where they'll present to us the taxation of family foundations under the UAE corporate tax system. Please welcome them to the stage.
Thank you very much, Rhoda. Your Excellencies, ladies and gentlemen, thank you again for dedicating your time to attend this session provided by the FTA, and the session is focusing on family foundations and the treatment of family foundation for corporate tax purposes. I think we will go through this agenda. Basically, we will talk about key element of the corporate tax law just to set the stage for our presentation. And then we will talk about some key feature of the family foundation corporate tax regime according to the corporate tax law, and also a ministerial decision 261 of 2024, which replaced the older ministerial decision on unincorporated partnership and family foundation. We will talk about the condition to be a family foundation. We will speak about multi-tier structure for family foundation. We will talk about family, single family office and multiple family office structure, the city implication of this structure, the compliance aspects for family foundation that are treated as unincorporated partnership, and then we will end the session with some questions and answer based on the question received from the audience. I think it's important for to set the stage for our presentation to talk about the legal framework for the corporate tax legislation in the UAE. We have mainly Federal Decree Law, which was issued by His Highness President of the UAE, Federal Decree Law 47 of 2022. We have also a certain number of cabinet decisions, a certain number of ministerial decisions. We have FTA decision issued by the chairman of the board of directors of the FTA. And then we have additional resources, FTA guides, around 25 corporate tax guides have been published. The last guide is about family foundation, actually. It was published in English, I think around 1 month ago, and the guide is being translated now into Arabic. We have also a certain number of FTA public clarification on specific corporate tax topics. So whenever I think you are considering or you are assessing the corporate tax aspects of a transaction, I think you need to go through the law and then see whether there is any relevant cabinet decision, ministerial decision, FTA decision, which is applicable to your situation or transaction. And then also you need to consider the additional resources, which are the FTA guidance and the public clarifications. In general, for corporate tax purposes, we have juridical person, we have also natural person. So juridical person or legal person, and also natural person. And these are always divided in two categories, resident person and non-resident person. So we can have a resident juridical person, a non-resident juridical person. We can have also a resident natural person and also a non-resident natural person. And this is extremely important for domestic corporate tax purposes, but also in a cross-border context. If we look at the tax period, what is the tax period for taxable person? So basically, a taxable person is required to file and report his tax return for each tax period. The tax period is the financial year or part of the financial year, and the financial year is in general the Gregorian calendar year or any 12-month period for which the financial statements are made and prepared. A taxable person may apply to the FTA to change his tax period, and there is an FTA decision on the condition to apply to change the tax period. A very important comment for natural person will always have a tax period following the Gregorian calendar year. The tax period for natural person is the Gregorian calendar year, so from January till December. The first tax period for natural person is the Gregorian calendar year 2024. So it goes from January 2024 up to 31st December 2024. Income derived by natural person before 1st of January 2024 will not be considered for corporate tax purposes. Now, if we look at resident juridical person, who is considered as resident for corporate tax purposes in the UAE? A resident person is a person that meets one of the two criteria that you see on the slide. So either the person is incorporated, established, or recognized, so deriving his legal status from the laws applicable in the UAE, whether in mainland or in free zones. We have also juridical persons that are incorporated in a foreign jurisdiction. However, they are effectively managed and controlled in the UAE. What does it mean? effectively managed and controlled in the UAE, basically it consists in having the strategic and key managerial decision prepared and made in the UAE over the tax period. So if you have an entity that is incorporated in a foreign jurisdiction, this entity is having all the board members based in the UAE, the key managerial and strategic decision prepared and taken in the UAE over a certain tax period. Very likely this foreign incorporated entity will be considered as effectively managed and controlled in the UAE, and it will be considered as a resident person in the UAE. It will be required to register and file and comply with all the corporate tax requirement. Of course, if the entity is incorporated in a foreign jurisdiction, it may very well happen that this foreign jurisdiction also is applying a corporate tax system, and this entity, because it is incorporated in the foreign jurisdiction, it will be considered as also resident in that foreign country, foreign jurisdiction. Then in that case, we will have a situation of dual residence, and the dual residence situation will be solved based on any applicable double taxation agreement. And double taxation agreement, they have what we call tiebreaker rules. So they have a rule to solve the dual residence situation. Usually it's in Article 4 or the article dealing with the residence. And then we have the last paragraph of this article which refers to the tiebreaker rules. The dividing rule will be either the place of effective management and control. It could be also any other criteria, the country where the head office is located. The criteria also could be kind of a mutual agreement resolution that is reached by both competent authority in the contracting states. If a person is resident in the UAE, so if a juridical person is resident in the UAE, the person will be subject to tax on his worldwide income, which means income derived from UAE and income derived from outside the UAE. For income derived from outside the UAE, of course, this income could be subject to taxation outside the UAE. And in that case, if the income is also subject to tax in the UAE, relief from double taxation will be provided based on the foreign tax credit rules under Article 47 of the Corporate Tax Law. Now, what about non-resident person? A non-resident person is a person who is not a resident, who does not fit in the definition of residence and meets one of the following requirements. So either he has a permanent establishment in the UAE, or has UAE sourced income, or the person has a nexus in the UAE in the case of foreign juridical person. So one of these three situations, if a non-resident person meets one of these definitions, he will be considered as a non-resident for corporate tax purposes. The first situation is to have a permanent establishment in the UAE. The second one is to have UAE state source income as defined by Article 13 of the Corporate Tax Law. And the third situation is to have immovable property from which you derive you generate an income. The immovable property in the UAE from which you generate an income. And in the case of a nexus in the UAE, the nexus concept is applicable only to foreign juridical person. So it applies to foreign companies. It does not apply to non-resident natural person. So if you are a natural person, you own a property in the UAE, you rent that property as a natural person, your private capacity, you are not considered to have a nexus. The nexus concept, again, is applicable only to non-resident juridical person. If a foreign company established in Spain, for example, for investment purposes decides to buy a few apartments in the UAE, and then it rents these apartments, they will be considered to create a nexus in the UAE, and the Spanish company will be considered as
a non-resident person that is a taxable person, and it will be required to register and comply with all the corporate tax obligation. So filing, documentation, etc. Now, what about the permanent establishment concept? So under Article 14 of the corporate tax law, a non-resident person would be considered to have a permanent establishment or a PE if he has a fixed place of business, so a fixed place PE, and it's a place through which core business activities are conducted with a certain level of permanency in time and also a geographic permanency. The permanency in time means that the non-resident person, he should conduct the activity for at least 6 months within the UAE. The 6-month threshold has been mentioned in the corporate tax law with respect to construction sites, to construction activities. For other activities, it is mentioned in the corporate tax guides on non-resident person. The second situation where a non-resident person would have a permanent establishment in the UAE is the dependent agent situation. It is a situation whereby the non-resident person has a person in the UAE that habitually conclude contracts or negotiate the main part of the contract on behalf of the non-resident person. And in that case, this person in the UAE who is negotiating the main contract and concluding contract, he will create an agency permanent establishment for the non-resident principal in the UAE. And all these sales derived through that agent, they will be attributable to that permanent establishment in the UAE. What is the corporate tax base in the case of a non-resident person? Basically, for a PE is the income attributable to the permanent establishment in the UAE. For the nexus, in the case of a non-resident juridical person, it's the income arising from the immovable property that is located in the UAE. And for state source income that is not attributable to a permanent establishment, basically it will be the gross amount of this state source income. However, as we can see we will see in the following slide, the corporate tax rate now on state source income is 0%. So basically state source income is subject to withholding tax according to Article 45, and the withholding tax now on state source income is 0%. Now, what about the corporate tax features that are applicable to natural person? So natural person is subject to corporate tax only if they conduct business or business activities in the UAE. And the second requirement, and most importantly, is that the turnover derived from such business or business activities exceeds 1 million UAE dirham within a Gregorian calendar year as of calendar year 2024. So the income the gross income, the turnover should exceed 1 million UAE dirham within the Gregorian calendar year, which means from 1st of January to 31st December, starting from the calendar year 2024. What is the corporate tax base for natural person? So basically, income from business or business activity in the UAE, and also the income from outside the UAE if this income relates to the UAE business or business activity. And this rule is reflected in Article 12 of the corporate tax law. When assessing whether the natural person reach the 1 million threshold, specific types of income, they need to be excluded. And these are wages and salaries, personal investment income, and real estate investment income. So these types of income, they need to be excluded for corporate tax purposes. Maybe we can shed the light on what are these types of income. So for wages and salary, any wage or remuneration given to an employee in consideration of an employment relationship, whether this remuneration is paid in kind or in cash, and whether it is payable annually, monthly, weekly, daily, hourly, it doesn't matter. What about private investment income? So private investment income is any income derived from an investment activity that is conducted by a natural person in their private capacity, so for their personal account, that is not conducted through a license, or also it does not require a license to be conducted. The activity also, the deriving or generating the personal investment income, it should not be an activity that is considered as a commercial business in accordance with the commercial transaction law. For example, a bank account that generates interest, saving accounts, bonds that are purchased by the natural person and also generate interest, all of this will be considered as personal investment income. Now the last category is real estate investment income. And real estate investment income also is excluded when assessing whether the natural person reached the 1 million threshold. So basically, any investment activity conducted by a natural person related to, directly or indirectly, to the ownership, leasing, subleasing, renting of land or any real estate property. And again, the requirement is that this activity should not be conducted based on the license, and also it should not require a license. If there is no license, it doesn't mean that the exemption applies. The activity should not also be requiring a license according to the regulation and legislation applicable in the UAE. These exclusion and these definition for excluded income for the taxation of natural person for corporate tax purposes are based on the wording of Cabinet Decision 49 of 2023. Now, what about the corporate tax rate? So for natural person, taxable income up to 375,000 dirham is subject to 0% tax rate. What exceeds this threshold is subject to 9%. For resident person, we apply also the same rate. For non-resident person, also the same rates and threshold. For non-resident person with state source income, we apply withholding tax, and the withholding tax rate currently is 0% based on Article 45 of the Corporate Tax Law. Just a comment regarding the corporate tax rate. There is also a special corporate tax rate for qualifying free zone person, which is applicable on their qualifying income. If qualifying free zone person, they meet certain requirement, their qualifying income will be subject to 0%. The non-qualifying income will be subject to 9% without benefiting from the 0% up to 375,000 dirham. So for a qualifying free zone person, the corporate tax rate applicable are 0% on the qualifying income and 9% on the taxable income that is not a qualifying income. Now, what about partnerships? Partnerships, I think it's an important concept for corporate tax purposes, which uses, and provides for a regime for mainly unincorporated partnership under the corporate tax law under Article 16. So a partnership is an arrangement, relationship, contract between two or more persons to carry on business together and to share the profits and losses of that business. In the UAE context, a partnership could be either an incorporated partnership or unincorporated partnership. The key factor to distinguish between incorporated and unincorporated is the fact that the entity has separate and distinct legal personality from the owners of the entity. So the distinguishing factor, the most important distinguishing factor in that case is that between unincorporated partnership and incorporated partnership is the fact that incorporated partnership, it has a separate legal personality from its partners, whereas an unincorporated partnership does not have a separate legal personality. And this is a key element also that is extremely relevant for the corporate tax regime of family foundation. So an incorporated partnership that has a separate legal personality will be considered as, of course, juridical person and is a taxable person in its own right for the sake of the corporate tax law. Whereas an unincorporated partnership, which does not have a separate legal personality from the partner and is not a juridical person or natural person, therefore an unincorporated partnership with no legal personality is not a taxable person in its own right for corporate tax purposes, unless this unincorporated partnership will make an application to be treated as a taxable person based on Article 16, Paragraph 8 of the corporate tax law. And if this application is approved by the FTA, then this unincorporated partnership will be treated as a taxable person for corporate tax purposes. I think this slide summarizes the regime of partnerships in the UAE. So as we said, a partnership is an arrangement, relationship, or contract between two or more persons to carry on business together and share profits and losses derived from that business. If the partnership has a separate legal personality from the partners, then in that case, it will be considered as incorporated under the federal law or Emirates, local Emirates in the UAE, and then the incorporated partnership in that case is systematically treated as a taxable person. If this arrangement or this relationship does not have separate legal personality under the applicable legislation in the UAE, then basically it will be treated as a transparent. So basically we will not look at the arrangement, we will look at the partners who are conducting the business. And the only exception to that is if this unincorporated partnership with no legal personality will make an application to be treated as a taxable person based on Article 16.8 of the corporate tax law. If an application is made to the FTA under Article 16, Paragraph 8, then the unincorporated partnership will be treated as a taxable person. The additional element is that Cabinet Decision 63 of 2025, which was released recently, it also considers any unincorporated partnership that is considered as a taxable person based on the approval of the application made to the FTA. It considers this unincorporated partnership as a juridical person and also as a resident person. If there is an unincorporated partnership with no separate legal personality and there is no application that is submitted to the FTA to treat it as a taxable person, then the unincorporated partnership will not be considered as a taxable person. And then we will look at the partners and we will look at the person who are behind the arrangement, and we will apply a full transparency based on Article 16.1 and mainly 16.2 and 3 of the corporate tax law. So we look at Article 16 dealing with an incorporated partnership, and we look at the partners, and we will assess the taxable income at the level of the partners of the unincorporated partnership. So just to set some examples on unincorporated partnership. So as we said, a partnership is a relationship established by contract between two or more persons according with the applicable legislation in the UAE. A partnership, an unincorporated partnership, could be a partnership under the corporate law in the UAE. It could be a trust, it could be a joint venture, it could be a consortium, it could be an association of persons. The main criterion here to be treated as an unincorporated partnership is that this unincorporated partnership, this arrangement, should not have a separate legal personality which is distinct from its owner, which is distinct from the partners. And we talked about the, just to explain the context, we are talking about an incorporated partnership because it is extremely relevant for the family foundation. Because one of the key aspects of the corporate tax regime of family foundation is a situation whereby a family foundation can apply to be treated as transparent. And then we go to a sort of a reverse situation. Family foundations are covered under Article 17 of the corporate tax law, and if certain conditions are met, the family foundation can apply to be treated as a flow-through, and then we will look at the member of the family foundation and not at the family foundation itself as a legal person. Who can be a partner in an unincorporated partnership? So basically, a natural person, a juridical person, whether a UAE or foreign incorporated juridical person. It could be also a combination of both, juridical person and natural person. The partner in an unincorporated partnership, they could be also resident person or non-resident person for corporate tax purposes. And I hand over to my colleague, Zubair, to talk to you about the, some key aspect on the family foundation.
Thank you, Rida. Good morning, Your Excellencies. Good morning, ladies and gentlemen. Thank you for being here today. So in the next part of the presentation, we're going to turn towards family foundations. And you will understand why the context that Rida has just gone through is so important. A lot of the concepts, the terms that he's just talked about, resident persons, nexus, unincorporated partnerships, are all relevant when we talk about family foundations. So let's first start with what is a family foundation itself. Before we look at the corporate tax implications, and an overview of the corporate tax consequences of family foundations, let's break down the definition. So Article 1 defines a family foundation as any foundation, trust, or similar entity that meets the conditions of Article 17. So we can take from this that this is a concept for corporate tax purposes. And that's why we will look at each in turn. We'll look at foundations, we'll look at trusts, and we'll understand together what is a similar entity. The important point to note here, these entities are not governed by the tax law. This is non-tax law. So a foundation or a trust or a similar entity is created under non-tax legislation in the UAE. And it can also be legislation in other jurisdictions. Rida's mentioned non-resident persons. They can also, if there's a foundation or a trust in a foreign jurisdiction, they may also be able to interact with the family foundation regime in the corporate tax law. Now, the corporate tax treatment. Before we turn to Article 17 and what happens when you meet the conditions, the starting point is that a foundation, trust, or similar entity, it will have a separate legal personality. So what does that mean? It means that they are a juridical person. So they are considered as a separate legal person. They are taxed in their own right. And that's only in the first instance. And we'll break this down and go through step by step. But the first point to note is at the starting point, before applying Article 17, before looking at the conditions, the starting point is we have a juridical person which is taxed in its own right. Now, Ridha's mentioned unincorporated partnerships and has discussed how that is effectively a transparent entity. So any income flows through that entity. And that is what is achieved by Article 17. So once the conditions are met, the purpose of having Article 17 there is to allow a juridical person, a separate legal person, to turn or be considered as an unincorporated partnership. So that is the second step. The first step, just to recap, is you are a juridical person in the first instance. Article 17 then allows you to be treated as an unincorporated partnership. Now, there are instances, and this will become relevant later on in the presentation, but there are instances where these entities, foundations, trusts, and similar entities may already be unincorporated partnerships. They may already be transparent under the relevant legislation. If that's the case, no application needs to be made. Article 17, the application there does not need to be made, but we can still see and will still respect that if they meet the conditions under Article 17, then they will be considered as a family foundation that has met the conditions. So what happens when a family foundation is treated as an unincorporated partnership? At a high level, what does it mean? It means that the income is attributed to the underlying beneficiaries. And we'll go through a number of examples, but if a family foundation exists, again, at a high level, if a family foundation exists and it has beneficiaries under that family foundation, rather than the income being recognized in the family foundation and at that level, by virtue of Article 17, they have now become transparent. The income now flows through to the underlying beneficiaries. And this is why the concepts that Ridha talked about were so important. When we have natural persons who are the beneficiaries, if they are generating real estate investment income, if they're generating personal investment income, they will not be taxed on that income. That income will flow through and it's excluded for the purposes of corporate tax. We'll return to these points in some more detail shortly, but that is at a very high level an overview of family foundations. We'll start going through each of the terms in the definition. Again, the context is hugely relevant for family foundations, and we appreciate it's very new to the UAE, especially under the guise of corporate tax. So, foundations, as we understand and we know that they can be created under several free zones. So we have DIFC, we have ADGM, and RAC ICC, which offer foundations to be created in these free zones. Now, I mentioned earlier there can be foundations in overseas jurisdictions, and that's also fine. And some free zones in the UAE also respect and allow foundations from overseas to operate in the UAE. And that's part of the flexible business environment that we are in the UAE. Now, those free zones respect and allow those foundations to operate here. And that effectively, for both those created here, those operating here, would fall within our definition of a foundation. Now, foundations as they exist typically do not carry out commercial activities. They exist for the management of wealth between families and generations between families, and that's the purpose of family foundations and foundations existing. So the concept of a foundation generally would not, you would not have commercial activities being carried out. They may be ancillary or those necessary for doing those activities, but on a general note, our view is and our understanding is that a foundation would not be carrying out commercial activities. The reason I mention this, we will come on to conditions later on in this presentation. Suraj will talk us through this. And one of the conditions will be the activity that the family foundation carries out in order for it to be transparent. And just a final point to note, a foundation or a family foundation, as we just mentioned, if it has a separate legal personality in these free zones, if it's incorporated in a free zone in the UAE and it is provided with separate legal personality, that means it's a juridical person in the first instance. Now we'll turn to trusts. So again, the definition of a family foundation is foundations, trusts, or similar entities that meet the conditions of Article 17. So trusts. Trusts are a legal arrangement where a settlor effectively passes their assets to the trust for the benefit of the beneficiaries. And it's the trustees that will manage the trust itself and the assets. And the settlor will surrender their rights to those assets. And ultimately, as we understand, it's for the beneficiaries to benefit in the long term. Now, a trust is governed by a trust deed, but you can have different types of trusts. And the important distinction to note is you can have unincorporated trusts or you can have incorporated trusts. What does this mean for corporate tax purposes? So let's first turn to unincorporated trusts. Rida provided an overview of Article 16, unincorporated partnerships. If an unincorporated trust exists, it would fall within the definition of an unincorporated partnership. It has no separate legal personality. Any income, any assets, any expenditure would flow through to the underlying partners. And there are trusts in the UAE, for example, those established in DIFC and also ADGM, which provide the flexibility and they offer unincorporated trusts to be created in these free zones. Now, contrasting that, we have incorporated trusts. So again, going back to what I mentioned earlier, and as we've seen with foundations, they are juridical persons. They are incorporated entities with a separate legal personality. And we have examples in the UAE of incorporated trusts also. Now, there are some nuances, and you'll cover the term, and we'll hear the term public benefit entity. Where that is the case, and there are trusts which are set up in this manner, they are, in the first instance, a juridical person. Then there are provisions relevant to public benefit entities, but we'll come on to shortly why that's relevant for family foundations. Similar entities. So this is the next limb of the article. And it's a term which still requires the conditions of Article 17 to be met. So what do we mean by a similar entity? It effectively has the same requirement. It's an entity which is to be used for the administration of family wealth, and again, is not a commercial company. So this will have to be considered on a case-by-case basis. What is this type of entity? But if there is an entity which, in essence, is and operates as and was created as a foundation or a trust was, but in name and title is not specifically a foundation or a trust, it also can fall within the remit of Article 17 of the Corporate Tax Law. So again, the first point on the right of the screen, a family foundation in the first instance is a taxable person. Now, there are also entities which can be wholly owned and controlled by a family foundation. And I'll just make the distinction between the two parts of the slide. So a similar entity is under the definition of Article 1 of the Corporate Tax Law. That's the precursor that pushes us to Article 17, where the conditions are under 17.1. Now, Ministerial Decision 261, as was mentioned earlier, provides the basis for, and this is as per Article 5, Clause 2 of the decision, it provides a basis for entities which are wholly owned and controlled by a family foundation. Now, we will come on to multi-tier structures shortly, but just to provide an overview and some context to those later discussions, the corporate tax law provides for instances where a family foundation exists. So we have a foundation, trust, or a similar entity, and they wholly own and control other entities. And this exists because we understand that these structures are not single entities. There are structures which involve and incorporate multiple entities, and the corporate tax law addresses this by respecting these structures that exist in the UAE. So if there are entities underneath a family foundation which are wholly owned and controlled, the place to look would be Article 5.2 of Ministerial Decision 261. So the scope is slightly wider for these entities. They would be effectively a juridical person, but the nature of those entities would effectively be wider than the remit of a family foundation which sits at the top of that structure. And so examples of those juridical persons could include limited liability companies and other type of special purpose vehicles. But it's always worth noting that they still are required to meet the conditions of Article 17 of the Corporate Tax Law. So now we've covered Article 1 of the Corporate Tax Law, the definition of a family foundation. We've looked at similar entities. We've looked at the definition and the remit of Article 5.2 of Ministerial Decision 261. Let's turn to Article 17 and why it exists and what happens. So we've touched on this a couple of times, but we'll go through a few slides to dig slightly deeper. So the starting point, a foundation, trust, or similar entity is subject to corporate tax in its own right. Where the conditions are met, they are regarded as a family foundation, and then they can apply to be treated as an unincorporated partnership. And that's an important point to note. There is an application that's needed. Article 16, which Rida mentioned earlier, of unincorporated partnerships, that's existing treatment which respects the existing parameters of the law. There is an unincorporated partnership which exists, and that's a fact. For Article 17, an application needs to be made to effectively consider that entity as a flow-through entity. And it, of course, is subject to approval. Now, there's also instances where a trust, a foundation, may exist and not be a juridical person, as we've just mentioned. Now, in those situations, they may also have entities which are below them. So the fact that they don't need to make an application to be transparent, to be treated as an unincorporated partnership, would not prohibit the entities underneath from applying to be transparent, and that's Article 5.2. So the position in this instance is if you have an unincorporated partnership that is in effect a family foundation, but you are already transparent, as long as you are meeting the conditions of Article 17, this transparent entity is meeting those conditions, then the similar entities, the entities which are wholly owned and controlled by that unincorporated partnership, will also be able to avail the same treatment. And so, just to note, an application does not need to be made, but they are still held to the same standard. They still need to meet the conditions of Article 17.1 of the Corporate Tax Law. And that's the point at the bottom of the slide. A fiscally transparent entity meets the conditions, it will automatically be treated as a family foundation. But the key point there to note is it still needs to meet the conditions. And why is that relevant? Because otherwise it would fall under Article 16, which is the case. The reason it's relevant and they need to meet the conditions is to allow for the entities underneath that structure to avail and utilize Article 5.2 of the Ministerial Decision. So just to recap, and the reason we're going the step further is now what happens under the corporate tax law. You've met the conditions of Article 17, and the consequence is that you are now treated as an unincorporated partnership. So you're not a taxable person, and you'll remember from the diagram and the chart that Rida showed earlier, you're effectively transparent, you're a flow-through entity. And so that means each partner is taxed on their distributive share of the assets, liabilities, income, and expenditure. What does that mean for family foundations? It means that the beneficiaries are effectively the partners in this situation. So that income which would have gone to that foundation, to that trust, to that similar entity, flow through, it's treated as an unincorporated partnership, it flows through to the beneficiaries. So now let's look at the partners, at the beneficiaries, and what would actually happen. And this will start to give some color to why Article 17 exists. So a natural person partner is subject to corporate tax on their respective distributive share. Let's pause there. What does that mean? So if there's several beneficiaries under a foundation, under a family foundation, and let's say they all have a third each, it means any income which is generated and received by the family foundation would be given to each beneficiary in that respective share. So as a partner in a partnership, an unincorporated partnership, the same way here with a natural person, they would get their respective distributive share that they are entitled to. Now, do they fall within the scope of corporate tax or not? And that's a key question for a natural person and for beneficiaries. So they do, and Rida mentioned earlier, the 1 million threshold, and he also mentioned the exclusions of personal investment income and real estate investment income. Why is this important? Why is it relevant for Article 17? By having this here, it allows that the underlying investment effectively would be treated the same way had that natural person undertaken this activity themselves. So the fact that a family foundation exists does not alter the treatment purely because a different vehicle is making that investment on behalf of the natural person. So by virtue of having that flow-through treatment, the transparent nature of a family foundation, we look at the partner and say, how would it be taxed in the hands of that partner? And this effectively is the reason Article 17 exists. It says we will respect what you would have and how you would have been taxed in your own right by virtue of making the entity which is doing this on your behalf, managing wealth between generations for families. How that entity is doing it should not alter your corporate tax treatment. And that's the importance and the relevance of family foundations. So any investment income that a family foundation has, and of course this is subject to Article 1, the definition that we discussed, Article 17, the conditions that we will come on to shortly. But if we get to that point, if a family foundation is treated as an unincorporated partnership, and that family foundation is undertaking investment activities, if it's generating investment income, if it's generating, that's personal investment income or what would constitute as real estate investment income, then it would be excluded for the beneficiaries. So a natural person partner would not have to pay tax on that income. It's excluded by virtue of Cabinet Decision 49. Now, let's turn to a partner or a beneficiary that may be a juridical person. So a juridical person, we understand, and we've covered this now, is a taxable person in their own right. We're not talking about the family foundation anymore, we're talking about the beneficiary. We're talking about the underlying partner. So they would be subject to tax on their distributive share. And there's certain elements which are going to be relevant for them, how they get their income, why would they get their income, in what instances. And the context here is effectively public benefit entities. So the beneficiaries, and again, we'll come on to these conditions shortly, the beneficiaries will either be identified or identifiable natural persons or public benefit entities. So there are instances that a juridical person, that's a resident person, could be one of the beneficiaries and therefore treated as one of the partners. We also can have instances where a partner or an underlying beneficiary is a non-resident person. So there's no requirement under the corporate tax law for the underlying beneficiaries and therefore the underlying partners to be resident in the UAE. And so, again, these points that Rida discussed before, a non-resident person with a nexus may also be relevant in this instance. And the reason and I'm sure some of you will know this, the reason I mention nexus rather than a PE is because a PE is effectively undertaking business. And the family foundations is not for the purpose of business to be conducted, it's for the purpose of investment to be conducted. And respecting, of course, the underlying treatment to the beneficiaries that would have happened if the entity in itself did not exist. I will now pass to Suraj, and Suraj will now go to the conditions and how a family foundation would need to meet the conditions of Article 17. Thank you.
Pleasure. Good morning, everybody. My name is Suraj Prem Chabra, and I have the privilege today to go through the conditions to be a family foundation. My colleagues have already gone through the general concepts of corporate tax to help get to this point. And thank you for Zubair to going through the type of entities which can be a family foundation. So in my part, we're going to go through an overview of the conditions. There are 5 conditions which we'll go through, and then we'll also look at foreign entities in relation to family foundations. So, the conditions. On the screen, you'll see 5 conditions. The beneficiary condition, the principal activity condition, the no business activity condition, no tax avoidance condition, and a distribution condition. The first 4 are provided for in Article 17.1, and the 5th condition is provided for in Article 5.1 of Ministerial Decision 261 of 2024. I'll go through a high-level overview of these conditions, and then we'll break this down and go into a bit more depth. So firstly, the beneficiary condition. So here, the family foundation must be established for the benefit of identified or identifiable natural persons. On top of that, a beneficiary can also be a public benefit entity. The principal activity condition. So here, the principal activity of the family foundation is to receive, hold, invest, disperse, or otherwise manage assets or funds that are associated with savings or investments. And following on from that, we have the no business activity condition. So we've talked about doing the investments. And as my colleague Zubair has already mentioned, the family foundation cannot carry out or conduct any activity that would constitute business or business activity had these activities been held by the natural person. And a natural person, of course, can be a beneficiary, it can be the founder, or a settler. The no tax avoidance condition. So the main or principal purpose of the family foundation is not for the avoidance of corporate tax. And lastly, the distribution condition. This distribution condition is only applicable if one of you or more of your beneficiaries are a public benefit entity. If a public benefit entity were to receive income through a family foundation, And had they received that directly, it would be taxable income, then they will not meet this condition. However, if the family foundation distributes this income within 6 months of the end of the tax period, this condition is met. And we'll go through an example of this. So let's go through all the conditions in a bit more depth. Here we have the beneficiary condition. And as we've stated, the foundation, trust, or similar entity must have beneficiaries whereby they are identifiable or identified natural persons, or it can be a public benefit entity. The beneficiaries themselves, it can be indirect, so it can be through a chain of other entities, provided they are fiscally transparent for corporate tax purposes. There is no minimum or maximum number of beneficiaries that can be prescribed by the family foundation, and there are no requirements or restrictions that the beneficiaries need to come from the same family. When we refer to an identified natural person, this is someone who is actually named as a beneficiary. And this must be on the charter of the foundation, trust, or similar entity. When we refer to identifiable, this is someone who's not specifically named, but it's a class of natural persons. And an example of this could be my child, my grandchild of the settler. And such persons may not even be born when the trust, foundation, or similar entity is even set up. But as long as it's identifiable, they can be a beneficiary. And lastly, we have a public benefit entity. This takes its ordinary meaning, and typically a public benefit entity is established for the welfare of the public and society, and it promotes philanthropy, community services, or corporate and social responsibility. Examples of this are not-for-profit or charitable organizations, and they can be established in the UAE or elsewhere. The principal activity condition. So in order to meet this condition, the principal activity of the family foundation must be to receive, hold, invest, disperse, or otherwise manage assets or funds associated with savings and investments. Now, this can include any type of investment, so purchasing and selling stocks, bonds, real estate, or other assets. And the idea is to grow the value and to generate an income for the beneficiaries. Now, when you have the family foundation, you can also distribute funds for specific purposes. And here we've shown some examples. So if you are supporting your beneficiaries, you are funding charitable activities, or you're just covering the operational expenses, that's allowable. But it must be within the objectives and legal obligations of that family foundation. The example we got here is that you may pay fees to your investment manager or even a family office that actually operates and manages the assets of the foundation. The no tax avoidance condition. As I previously mentioned, the main or principal activity of the family foundation must not be for the avoidance of corporate tax. And just by making this application under Article 17 of the Corporate Tax Law to be treated as an unincorporated partnership does not mean that that in itself is a tax avoidance purpose. That's allowed by the legislation to help for the beneficiaries. The no business activity condition. My colleague Zubair has already touched upon this, but again, the idea here is that the family foundation must not conduct any activity that would constitute a business or business activity if it was undertaken by the natural person. And again, the whole purpose of having Article 17 is that a beneficiary, if they were to undertake this themselves, would be able to claim this as personal investment income or real estate investment income. So using a family foundation shouldn't hinder you. So we have this for natural persons. We've talked about wage personal investment income and real estate investment income. These are not considered business and business activity for this purpose. And if the foundation, trust, or similar entity undertakes an activity that would be considered personal investment or real estate investment had it been undertaken by the natural person, that's absolutely fine. That's the whole purpose of the family foundation. So we'll go through an example on this. Here, we can see Foundation A has been set up. It holds and manages a portfolio of real estate properties, and this is mixed between residential and commercial. So firstly, it has residential units in the UAE, and it also has a hotel, which is a commercial unit, which it operates. There are two beneficiaries, Mr. B and Mrs. C, both of which are 50% have 50% beneficial interest. The residential units are rented out, and there is no requirement to have a license, nor is there an existence of a license. So for that specific area, the no business activity condition would be met. However, there is an operation of the hotel, and operating the hotel does require a license. Had Mr. B or Mrs. C operated the hotel themselves, they would require a license, so it would not be seen as real estate investment income or personal investment income. It would be seen as a business activity, and therefore the no business activity condition is not met. Even though there is a mix, there's part of the investment or operation using business. Therefore, the foundation as a whole does not meet all the conditions to be treated as a family foundation. And subsequently, it will not be able to apply to be treated as an unincorporated partnership. The distribution condition. So as I mentioned earlier, this is provided for in Article 5.1 of Ministerial Decision 261 of 2024. And this condition is only applicable where one or more of the beneficiaries are a public benefit entity. In order to meet this condition, there's condition A and B. You only have to meet one of them. If you meet A, you don't need to consider B. And A is, so we'll look at A first. So, this is where such beneficiaries are not deriving income through the family foundation that would be considered as taxable income had they derived it directly in their own right. So here we're talking about public benefit entities. Now, A can be met in two scenarios. Either the income that the public benefit entity receives is exempt. So it's exempt income. And this is provided for in Article 22 of the Corporate Tax Law. Examples of exempt income include dividends from a UAE resident juridical person, or income from a participating interest in a foreign juridical person. And when we talk about a participating interest, I won't go into much depth, but it's all about having a substantial amount of interest in a participation for a certain amount of time. The second option, if it's not exempt income, is that the public benefit entity itself can be a qualifying public benefit entity as defined in the corporate tax law. The conditions are set out in Article 9 of the corporate tax law, and once it meets those conditions, it must also be listed in Cabinet Decision number 37 of 2023. Here you'll see a list of all the qualifying public benefit entities. If you were to be on this list, then the income you receive would not be taxable income because you're exempt, and therefore you'd meet this condition. If you are in a situation where the public benefit entity cannot meet condition A here, then we can look at condition B. And this is, if you do receive income that would be considered taxable income, then this needs to be distributed. The actual income itself needs to be distributed to the public benefit entity within 6 months from the end of the relevant tax period. So provided that income that is taxable income is distributed within 6 months from the end of the tax period of that public benefit entity, the condition is met. And just to reiterate the last point, where condition A above is not met, condition B must be met in order for this condition to be met as a whole. So, we'll go through an example of this distribution condition. Here we have a family foundation that we are told that does meet the conditions of Article 17 of the Corporate Tax Law, and therefore it's recognized as fiscally transparent, i.e. an unincorporated partnership for this purpose. The family foundation has a Gregorian calendar year as its tax period. That means its tax period is January to December. And as we can see on the screen, it has two types of beneficiaries. Firstly, we have family members. These are all natural persons. And secondly, we have a charitable entity, which is a public benefit entity. For this example, it is not a qualifying public benefit entity. In the tax period of 2025, we've got a few scenarios. So firstly, February 2025. This family foundation has made a decision to buy 10% shareholding in a foreign company. So as we can see on the screen, there's a foreign investment in which it receives investment income. However, in October 2025, the family foundation sells 7% of their shareholding, and it makes a gain. Now, under the rules of participation exemption, this realized gain, the participation exemption would not apply. And as such, it would be taxable income had the charitable entity in the hands of the charitable entity. Therefore, as we mentioned before, it's not exempt income, it's not a qualifying public benefit entity, so it doesn't meet the first condition, which was A on the previous slide. The second distribution condition, which was B on the previous slide, in order for this condition to be met then, the family foundation is required to distribute the proportion of the income which was derived from that sale within 6 months of the end of the tax period. The tax period here is January to December 2025, So it must distribute that income to the charitable entity by the 30th of June 2026. And just to reiterate, this condition is purely for public benefit entities. So even though the distribution is happening to the charitable entity, there is no requirement for the family foundation to distribute that income to the family members. Now we'll look at an example with foreign entities. So in this example, we have a foreign foundation. It's established outside the UAE, and it is there to hold and manage UAE real estate, of which the beneficiaries are a UAE family and a foreign charity. The family foundation holds immovable property in the UAE, and it derives income from these immovable properties. As such, the foreign foundation has a nexus in the UAE, and therefore itself is considered a taxable person as a non-resident person with a nexus, and is therefore required to register. One second. So in this instance, it's registered as a taxable person. We now need to look at Article 17. If Article 17, the conditions are met, then this family foundation would now be considered as fiscally transparent as an unincorporated partnership, provided the application is approved by the FTA, and this is what it would mean in this situation. So firstly, as I've just mentioned, the foreign foundation would now become fiscally transparent and is no longer a taxable person in its own right. The UAE family members, they will not be subject to corporate tax because the income that is generated from the family foundation is real estate investment income, and that's part of one of the conditions of Article 17. The foreign charity will be considered as a taxable person because it's a non-resident person being a foreign charity with a nexus in the UAE. It's subject to corporate tax, and it will have to declare its distributive share of that income for the immovable property in the UAE. And just to remind you, in order for the family foundation to remain a family foundation, because the income is subject to tax for the foreign charity, it must distribute this within 6 months from the end of the tax period. I'll now pass over to Ruda, who will go through the next stage. Thank you.
Thank you so much, Siraj, and special thanks to our expert. Before inviting you all to take a short break, we would like to clarify that the authority has allocated an information desk in the main hall. You can contact them by the registration desk. They will be more than willing to answer your inquiries and assist you with any issues. See you back in 30 minutes. Thank you. Ladies and gentlemen, we hope you had a refreshing break, and now we move on to the second part of our workshop for today. Please welcome back once again our experts as they continue the session.
Thank you very much, Ruda. and welcome again, Your Excellencies and ladies and gentlemen. So in part 5, we will talk about multi-tier structure, and basically this is a reflection or description of a rule that is available under Ministerial Decision 261 of 2024, which is related to vertical structures whereby you have a family at the top, a family foundation underneath, and then underneath the family foundation you will have different vehicle, as I said, in a vertical structure. And we will look at some examples to describe the corporate tax treatment of these structures. So if we look at Ministerial Decision 261 of 2024, specifically Article 5, we have under Article 5 of this ministerial decision a rule whereby a juridical person may apply to be treated as an unincorporated partnership if it meets the following conditions. So there will be two main conditions. The first condition is that this entity, this juridical person, is fully owned and controlled by a family foundation that is also treated as an unincorporated partnership. And in that case, the ownership, it could be direct or indirect. If we are in a situation where there is indirect ownership, of course, it should be through an uninterrupted chain of entities that are themselves treated as an incorporated partnership, which means that are themselves treated as fiscally transparent. The second requirement is that this juridical person that is applying for this regime, it needs to meet also the condition of Article 17.1 of the corporate tax law. So basically the condition to be considered as an unincorporated partnership, and those conditions, they were described by my colleague Suraj. So the eligibility of juridical person in a multi-tier structure to be treated as an incorporated partnership, it must be determined for each entity separately. So you look at each entity and you assess whether the requirement, condition 1 and 2 are met. If a family foundation is by nature treated as an incorporated partnership without the need to make an application to the FTA under Article 17.1, then the first condition that we have here will be considered to be satisfied, notwithstanding the legal ownership of the trust assets and where the trust assets are vesting with. So these two conditions, they must be met continuously throughout the relevant tax period, in respect of which this treatment is claimed. And I think we need to look at the structure to understand better the requirement. So basically, if we look at any entity into multi-tier structure which are not fiscally transparent, so for example, a juridical person which has not made an application under Article 17, or who does not meet the condition of Article 17, if they will represent an interruption in the chain, any juridical person, basically where the structure of the ownership will be interrupted by an entity that does not meet the requirement of Article 17, or that is not considered as an incorporated partnership, will means that the entity underneath will not qualify for this treatment. So it is very important that there is an uninterrupted chain of ownership that meet the requirement of Article 17.1 of the corporate tax law. And if these requirements are met, basically, so this juridical person, despite the fact that it's a juridical person, that is a taxable person in principle, if this application is approved based on the fact that these requirements are met, basically the FTA will treat the entity for corporate tax purposes as a transparent entity, as an unincorporated partnership. Basically, they will not be subject to corporate tax in their own right, and then all the income, expenditure, assets, and liability will be deemed to arise to the ultimate beneficiaries of the top family foundation. So if this juridical person is deriving real estate income, the real estate income will be deemed to be realized by the family members who are beneficiaries of the family foundation. And these family members, when they get real estate income, it is considered as real estate investment income, which means that it is excluded for corporate tax purposes. I think if you look at the structure, you will understand much better. So here we have family A, and family A established a family foundation A in ADGM. So family foundation A is an ADGM foundation established to manage the assets of family A, and the family foundation is a juridical person, which means that it is a taxable person. It is required to register for corporate tax purposes. This is the first position. And then the family foundation A, it holds two subsidiaries in a vertical structure, so subsidiary B and subsidiary C's. And these two subsidiaries are LLCs that hold real estate properties for family A. So the family foundation A holds subsidiary B. Subsidiary B holds real estate assets. The same thing, subsidiary B holds another subsidiary C that hold also other real estate assets for the benefit of the family foundation A and the beneficiary of family foundation A. Subsidiary B in that case is wholly owned and controlled by a family foundation. Subsidiary C is wholly owned and controlled by subsidiary B, but it is also considered as wholly owned and controlled by the family foundation in an indirect manner. The family foundation A, it manages the family wealth for the benefit of the beneficiaries. So the top family foundation A, it applies to the FTA to be treated as an unincorporated partnership, which because of the requirements that are met under Article 17.1, this application is approved by the FTA. So in that case, income, expenditure, and assets and liabilities of the family foundations, A, will be considered as attributable to the beneficiaries, which are the family members of family A, in proportion to their distributive shares. But the approval of the application of the family foundation A to be treated as an unincorporated partnership, which means that it will be treated as transparent, it will have also other consequences. What are these consequences? So first of all, for subsidiary B is wholly owned and controlled by family foundation A. It meets the requirement of Article 17.1 of the corporate tax law. Subsidiary B can apply to be treated as an unincorporated partnership, and this application is approved, and therefore also the income, expenditure, assets, and liabilities are deemed to be those of the family members of the family foundation A. So it will go through the family foundation and go to the top to the family members who are the beneficiaries of the family foundation A. The same thing for subsidiary C. Subsidiary C is wholly owned by subsidiary B. Since the entity on top of subsidiary C, which is subsidiary B, is treated as an incorporated partnership, subsidiary C is also considered to meet the requirement of Article 17.1, and subsidiary C also can apply to the FTA for the same treatment, for the transparency, to be treated as an unincorporated partnership, which is a flow-through entity for corporate tax purposes, which is transparent for corporate tax purposes. And then in that case, if this application is approved, income, expenditure, assets, and liabilities of the
subsidiary C, which is an LLC, will be deemed to be realized by the family members. So the family member, the beneficiaries of the top family foundation. And then in that case, the income of subsidiary B, income of subsidiary C, they will be deemed to be that of the family members. And since this income is real estate income, the real estate income is derived by the family members, and then it will fall in the category of real estate investment income. And as I explained in the first part of the session, the real estate investment income is excluded for the sake of assessing the 1 million threshold for natural person, which means that it will not be subject to corporate tax. So I went back to the previous slides. Because of the fact that the top family foundation is considered as an unincorporated partnership via an application that is approved by the FTA, the other entities that are owned fully and controlled fully by the family foundation that is treated as an incorporated partnership, they can also benefit from the same treatment as the top family foundation. And in that case, they will benefit also from transparency. The same thing will go also to subsidiary C. And then if these requirements are met, you can benefit from the attribution of the income of subsidiary C, of subsidiary B, and also of the family foundation to the family members. And since this is a real estate income, it will be considered as real estate income derived by natural person, which is excluded for the sake of assessing the corporate tax liability based on Cabinet Decision 49 of 2023. The family foundation is, I think it's important to remind that the family foundation regime is a combination of many rules: natural person, an incorporated partnership, and then we have the family foundation. So we invested in the beginning of the session to talk about natural person, the regime of natural person, because it is very much connected with the corporate tax regime of family foundation. And just for your information, so the session is recorded and it will be also, the recording will be provided on FTA YouTube channel, okay? Just for your information. So the second example, we have an entity that is not wholly owned by one family foundation. So Family Foundation 1 and Family Foundation 2 are juridical person treated as an incorporated partnership based on an application under Article 17.1 of the Corporate Tax Law, which is approved by the FTA. The Family Foundation, both Family Foundation 1 and 2, they have jointly incorporated a real estate investment SPV in ADGM to hold and manage properties contributed by both family foundations. Family Foundation 1 holds 80% of ownership interest in the SPV, in the special purpose vehicle, and Family Foundation 2 holds the rest, the remainder, which is 20%. If the assets of Family Foundation 1 and Family Foundation 2 were held directly by the beneficiaries, the income would be treated as personal investment income. If the properties of SPV A were held directly by the beneficiaries, in that case, the income would be real estate investment income. So the income in the first case will be considered as personal investment income because the entity will be considered to distribute dividends, and then in that case, the natural person who are behind Family Foundation 1 and Family Foundation 2, they will be considered to get a dividend, an income from distribution of a juridical person. The critical point in that example is regarding SPVA. Is it possible for SPVA to apply to be treated as an unincorporated partnership based on the rules provided in Article 5.1 of Ministerial Decision 261 of 2024? So SPVA is not wholly owned and controlled by one family foundation. It's wholly owned and controlled by two family foundations, and therefore it is not eligible to make an application under Article 17.1 of the Corporate Tax Law in order to be treated as fiscally transparent. And then in that case, the income of SPVA derived by the SPV, by the special purpose vehicle, it will be subject to corporate tax. And if the SPVA will make an application, the application to be treated as fiscally transparent, to be treated as an unincorporated partnership, it will be rejected because it's not owned by one family foundation. The income attributed to the family members in respect of Family Foundation 1 and Family Foundation 2, including dividends from SPVA, will not be subject to tax because that income will be considered as a private investment income. So Family Foundation 1 and Family Foundation 2, they meet the condition of Article 17.1. They can apply to be considered as fiscally transparent. However, the SPV underneath cannot apply because it is owned by more than one family foundation. And this is based on the wording of Ministerial Decision 261, as I said, of 2024, Article 5 of this ministerial decision. If we look at another example, so basically a family foundation receiving taxable income in a multi-tier structure. We have a family foundation that is a juridical person with two types of beneficiaries in that case. In the previous example, the beneficiaries were natural person individuals. In that case, the beneficiary, we have two types of beneficiaries, family members who are natural person and also a public benefit entity who is not, of course, a qualifying public benefit entity. It's the public benefit entity. The difference is that qualifying public benefit entities, between brackets, is an exempt person, and the list of qualifying public benefit entities is published based on a cabinet decision. So the family foundation owns and controls a limited liability company, which is a foreign company and not a participation interest for the purpose of the participation exemption rules. So the family foundation, which is owned by family members and a public benefit entity, this family foundation owns a foreign entity, an entity that is incorporated in a foreign jurisdiction. This foreign company pays dividends on annual basis. The family foundation both and the foreign company, they have the Gregorian calendar year as their tax period or financial year. And both the family foundation and the foreign company, they meet the condition to be treated as an unincorporated partnership if they apply to be treated as transparent, and in that case, they will receive an approval from the FTA to be treated as such. And therefore, in that case, the income generated both by the family foundation and the foreign company is deemed to arise to the family members and to the public benefit entity. Now, there is a peculiarity when the beneficiary of a family foundation is a public benefit entity. The income that is derived must not be taxable income if it had been derived directly by the public benefit entity. And in that case, because the participation exemption does not apply in respect of the foreign company, and the public benefit entity is not a qualifying public benefit entities, the dividends from the foreign company would be taxable income if it derives directly, if those income is derived directly by the public benefit entity. And accordingly, the first distribution condition is not considered to be met. Then we need to test the second condition, which is the requirement to distribute within a specific period of time. So basically, the family foundation needs to determine if it meets the second distribution condition, and this requires the family foundation to distribute to the public benefit entity its share of income within a period of 6 months of the end of his tax period. So basically, for a dividends paid by the foreign company to the family foundation in the tax period ending on, for example, 31st December 2027, the family foundation will need to pay the dividends, to redistribute the dividends to the public benefit entity in proportion to its shares before 30 or by 30 June 2028. If this does not happen, it will result in both that the family foundation and the foreign entities ceasing to be treated as an incorporated partnership. So this is a condition that needs to be tested, and this requirement is provided by, again, by the Ministerial Decision 261 of 2024. So if we have, again, a beneficiary of a family foundation, not only natural person, but a public benefit entity, the public benefit entity, the family foundation, and any subsidiary underneath or any entity underneath, they still can benefit from the transparency subject to meeting one of the conditions. So the income should be exempt if it would have been paid directly to the public benefit entity. If this condition is not met, then the family foundation have an obligation to distribute the income received from the foreign subsidiary to the public benefit entity within 6 months from the end of the financial year of the family foundation. I think you need to understand this. You need to read Article 5 of Ministerial Decision 261 and also the guides on family foundation that has been released recently. And these 3 examples, I think they provide an idea how the rules on family foundation are interpreted in a multi-tier structure, in a structure where you have family members owning a family foundation, the family foundation owning another entity, and then another entity underneath. And it happens quite often in practice. So many family foundations are established in that way. And the idea is that if you meet the condition, all the entities in that structure, they can benefit from the transparency, and then all the income will be attributable to the top owners who are the family member of the family foundation. The key requirement is that each juridical person should meet the transparency requirement under Article 17, 1 of the Corporate Tax Law, and also under Article 5 of Ministerial Decision 261 of 2024. I hand over to Zubair to talk to you about single family office and multi-family offices. Thank you.
Thank you, Rida. So, in the next part of the presentation, we'll talk about single family offices and multi-family offices, and we'll refer to them as SFOs and MFOs. And this is a topic which is, you could say, on the periphery of family foundations. So we'll go through a couple of examples on how they interact with the family foundations regime. And we'll start off with an overview of SFOs and MFOs, specifically the entities themselves. So as a juridical person, and this is on the basis that they do not meet the conditions of Article 17 of the corporate tax law, and on the basis that they do not meet the definition of Article 1. So what we visited earlier on in the presentation, Article 1 definition of a foundation, trust, or similar entity, and also not meeting the conditions of Article 17, they would be a taxable person in their own right. They would be a juridical person, and therefore they would be subject to corporate tax on the income, and that would include potentially the management fees and any other income that they receive. One point to note is that the SFO or the MFO will need to be remunerated on an arm's length basis for any services that they provide to related parties. Of course, that's as per the requirement in the corporate tax law. Now turning to the family members who may be using an SFO or an MFO in a structure, there are instances where the family members will not be subject to corporate tax on the income that they receive from these entities that we'll come to in just a moment. And that's on the basis that the income is actually excluded as per Cabinet Decision 49. So what we touched on earlier about personal investment income, real estate investment income, if the income that they receive from an SFO, from an MFO, has this characterization, then they will be excluded, and this is for natural persons, they will be excluded from the corporate tax base for those individuals. So we have income from a family wealth management vehicle that is a taxable person, so taxable person as a juridical person, and if the income that they receive falls into those two categories, the family members as natural persons will have said income excluded. There can also be instances where income is received from a tax transparent entity that has met the conditions of the corporate tax law. That can be either automatically as per Article 16 as an unincorporated partnership, or Article 17 by virtue of an application to the FTA, in which case again that income retains its characterization because of the flow-through nature of the entity, and again the income will be excluded. But let's look at a couple of examples, and just one point to note before we turn to the examples is that if the conditions aren't met and the entity is still transparent, so the Article 17's conditions aren't met and it's still an unincorporated partnership, if that is the case, because of the income being retaining its character, again, just to reiterate, it can still be excluded as real estate investment income, personal investment income. So we have a structure here which involves an SFO, a single family office. Now, in this structure, we have a family foundation at the top, and this is, as we've just discussed and Ridha's just taken us through, a multi-tier structure. So they are utilizing Article 1 and Article 17 for the family foundation at the top, and they're using Article 5.2 of Ministerial Decision 261 for the multi-tier structure. Now, we'll spend a moment going through the structure because there's a few slides which will then turn towards the consequences of this structure. So the family members are beneficiaries of the family foundation, and the family foundation in itself has a separate legal personality. The SFO and the holding company are also juridical persons, and you'll note from the diagram the SFO stands aside from the multi-tier structure. Now, the SFO holds a license, but it's not regulated by DFSA, and the employees provide family office services. We also have two SPVs here, two special purpose vehicles. So SPV 1 is involved in share investments, and we have SPV 2 here, which invests in real estate. So that's the structure, and let's turn to the consequences of what this means practically for each entity in this structure. So we have the holdco. So the holdco is the entity below the family foundation. It's wholly owned and controlled by the family foundation. It meets the conditions of Article 17 of the corporate tax law. It has applied as we know it is required to apply to be treated as an unincorporated partnership, and also the application was approved. It's not simply applying, but also the approval of the application. And therefore, the family foundation and now also the holdco are transparent. And so any income, expenditure, assets and liabilities will flow through to the family members who are the ultimate beneficiaries. We have SPV 1 and 2. They're wholly owned and controlled by the holdco, and they also meet the conditions. So again, even though they're a tier down, they're another tier in the structure, they still meet the conditions, and on the basis that they are passing the conditions that Suraj has talked us through earlier, they can also be tax transparent. Now the SFO, however, is on the side. As we saw in the structure, it's not part of the same chain, and therefore the SFO is a taxable person, and it will be subject to corporate tax on its income. And importantly, as I mentioned earlier, it will be subject to the arm's length principle. So any services which are offered to related parties need to be done on an arm's length basis. Now what would happen, so let's vary the facts slightly, but the structure remains the same. If the family foundation was not treated as an unincorporated partnership, it has an effect on the entities below. So the holdco and also SPV 1 and SPV 2, they would not be able to apply to be treated as an unincorporated partnership, and therefore they would be taxable persons. So if that top entity is not considered a family foundation, whether by virtue of not applying, not being approved, or simply not meeting the conditions of Article 17, the structure cannot benefit from the treatment of transparency to be treated as an unincorporated partnership. The SFO, however, in this situation remains the same. It's a taxable person, and it's subject to corporate tax on all of its income, and again, it must be aligned with the arm's length principle if it's providing services to related parties. Now we have a MFO here, a multi-family office, and in this scenario, the MFO provides family office services, including financial activities. So it is conducting a business, it's offering, it's effectively carrying out a commercial activity. Now, an MFO is and does exist to service more than one family, and it has the relevant authorizations from DFSA. In this situation, the MFO is a juridical person and therefore is a taxable person and subject to corporate tax on its income. The remaining chain is the same as we saw in the earlier structure. So in this instance, the positions would remain unchanged, on the basis that the family foundation has applied, has been approved, that it's met the conditions of Article 17, it's transparent. The entities below, holdco, could also then apply. On the basis that holdco has applied, SPV 1 and SPV 2 could also apply. So the multi-tier structure is not affected. If there's an SFO, if there is an MFO who are providing their services to a family foundation, to its beneficiaries, it does not disrupt this chain as long as this chain still meets the conditions that Rida has just mentioned about the multi-tier structure. Now, the next part of this presentation is going to talk about corporate tax implications. And this presentation so far has actually threaded these concepts throughout. So hopefully this is bringing all these principles into just a few slides, and it should be familiar on the basis of the topics that we've discussed so far. So to reiterate, a family foundation is treated as a UP. So this is on the basis that the conditions have been met, an application has been made, and an application has been approved. What next? The family foundation is treated as a UP and therefore is considered fiscally transparent and hence not subject to corporate tax in its own right. And as I alluded to before, the beneficiaries are therefore deemed to be partners in a UP, And so, what does that mean practically? And we can see this in Article 16 of the Corporate Tax Law. They are considered to be conducting or deemed to be conducting the activity of the family foundation. They are deemed to have the status, intention, and purpose of the family foundation, holding the assets, and deemed to be party to any arrangement which the family foundation is a party to. And that is the transparency. That is the corporate tax implications. By virtue of Article 17 existing, the transparent nature effectively results in this. So on the left of the screen, we have the assets, liability, income, and expenditure. Again, that is a consequence of transparency. So once an entity or a structure has been treated or considered a UP by virtue of it being a family foundation and meeting the conditions, they receive and are allocated to the beneficiary, they're allocated their proportionate distributive share. And that is relevant for each tax period, and it applies even if in instances, so we talked about trust earlier, and we talked about legal ownership, and legal ownership might belong to the trust itself. But for corporate tax purposes, by virtue of Article 17, Article 16 being treated as a UP, those assets, etc., are effectively considered to be in the hands of the partners because of the transparent nature of the entity now. So the corporate tax treatment then goes to each of the beneficiaries. And that means at each of the beneficiaries, they are considered in their own right. So, and that is in accordance with the general rules for determining taxable income under the corporate tax law. So each beneficiary, once the transparency has occurred, once income has flown through, once they have received their distributive share, each beneficiary effectively then has to determine its taxable income. Now, for natural persons, it's simpler. Their income is excluded on the basis that the family foundation cannot undertake any business or business activity, otherwise it wouldn't meet the conditions. So once it has met the conditions, any income which flows through to the natural persons is effectively excluded from the corporate tax base. But why have we mentioned that they would still need to determine taxable income? Well, it's because of public benefit entities. There are instances where a beneficiary could be a taxable person, i.e. a public benefit entity, and so any beneficiary has to consider their position in their own right under the ordinary principles. And don't forget, a natural person could have other business completely unrelated to this structure. They could have their own business or business activities and could have this structure completely separate to that. It still means the income from this structure would be excluded, but they would still have their remaining obligations under the corporate tax law. So the natural person we've just mentioned, they won't be subject to corporate tax on their distributive share of income on the basis that that income is personal investment income or real estate investment income. Of course, the conditions that we mentioned earlier are a requirement under Article 17(1). So by virtue of meeting that condition, the income would be excluded in the hands of the natural person. Now, the complexity, you could say, lies with the public benefit entity as a beneficiary, so let's spend some time on this. So there could be a qualifying public benefit entity, of course, which could be an exempt person. But there's instances where a public benefit entity exists and is not an exempt person, i.e. not qualifying. So if they are a taxable person, they need to include their distributive share of any income when considering and determining their own taxable income. A beneficiary which may not previously be a taxable person, and again, this is going back to the fundamental principles that Rida outlined at the start. It could be a non-resident person with a nexus. If they have immovable property, if the family foundation holds immovable property, it's then considered to be transparent, and that could result in a public benefit entity as a juridical person having a nexus in the UAE because it's earning income from immovable property. and therefore they need to assess and determine their taxable income under the corporate tax law. So for the public benefit entity, how would income work, and what does this mean for them? So we do know that income in the nature of dividends will be exempt from corporate tax in the hands of the beneficiaries if the following applies. So first, it's received from a juridical person that's a resident person. We can see that from Article 22 of the Corporate Tax Law and the chapter which outlines exempt income, or if it's received from a participating interest in a foreign juridical person. So, of course, this would require the relevant conditions of Article 23, the participation exemption, to apply, and that would need to be considered in the hands of the beneficiary. This also would apply in the nature of gains and losses, the transfer, disposal, sale, or any disposal of shares of a UAE or foreign juridical person. Also, that would require consideration, again, of participation exemption under Article 23. And there's a number of materials which exist out there. We have a guide on exempt income, and we also have published videos on determining taxable income, which covered participation exemption in some detail. So let's look at how this applies in an example. And you'll realize the focus, because of the last few slides, is going to be on the public benefit entity. So we have a family foundation here, which has 15% of a foreign company. This is not a multi-tier structure. That's not what we're trying to highlight here. We are trying to highlight and the focus is on the public benefit entity. What are the consequences for that public benefit entity? So the family foundation here has made an application, and they've received approval to be treated as an unincorporated partnership, i.e. fiscally transparent. And the primary objective is to hold assets. So they hold a 15% stake in the foreign company on behalf of all three beneficiaries, and they've held the shares for more than 12 months. The family foundation received dividends from the foreign company, and it then decides a year later to sell shares off the foreign company. Let's just deal with Miss P and Mr. Q here for just a moment. If the shares were held by them directly, that would be personal investment income, so therefore the income is excluded in the hands of the natural person, and that is the natural person beneficiaries effectively dealt with. So let's turn our attention to the public benefit entity. So the family foundation itself holds 15%, and the public benefit entity, by virtue of a third of that, will be treated as holding 5% of the foreign company. The transparent nature flows through. They have a third of the 15%, which gives us the 5%. Why is that important? It's important in the context of the participation exemption. So they have, and on the basis that they've met the other relevant conditions, it's a participating interest, and therefore they can exclude or exempt their share of dividends and capital gains in respect of the foreign company. And so they can exclude it from their taxable income on the basis that it is exempt income. And that's relevant when they are determining their taxable income. Now, if the conditions aren't met, if for any reason an Article 23 of the Corporate Tax Law outlines the conditions of participation exemption, they're not met, then the dividends and capital gains will be considered as taxable income. And as was discussed earlier in the presentation, by virtue of having these conditions, the family foundation would need to distribute its income to the public benefit entity within 6 months from the end of the relevant tax period. Otherwise, importantly, the distribution condition would not be met, and it would have an effect on the family foundation itself, and they would lose their transparent status, as they would cease to be treated as an unincorporated partnership. So we've already discussed Ms. P and Mr. Q. They will not be subject to corporate tax on their share of the dividends and the capital gains. because the income would be personal investment income, which is excluded from the corporate tax base. And importantly, as we've just alluded to, if that distribution condition is not met, Article 17, the conditions are not met, and therefore the family foundation itself would no longer be treated as an unincorporated partnership, meaning it would be a juridical person, and therefore a taxable person in its own right, and it would be subject to tax on any of that income it received. Of course, important to note, the family foundation as a juridical person could still consider the application of the participation exemption in its own right, because it would no longer be transparent, so it still can consider it at the level of the family foundation itself. I will now pass to Suraj, who will talk through the compliance for family foundations. Thank you.
Cheers, mate. Thank you very much, Zabir. So, as Zabir said, I'll be going through the compliance side. We've gone through all the theory. Now, what does it mean from a practical perspective for corporate tax purposes? And within the compliance, we'll look at 3 areas. We'll look at who needs to register, how you apply to be treated as an unincorporated partnership under Article 17 of the CT law, and the annual confirmation. So firstly, the corporate tax registration. So for family foundations, the family foundation, which is a juridical person, since it's a juridical person, will need to register for corporate tax. And because family foundations can have wholly owned and controlled subsidiaries, which are also juridical persons, they also would need to register. The registration must occur before it applies to be treated as an unincorporated partnership. And the deadline for registration are those in FTA decision number 3 of 2024. If a family foundation in its default form is already an unincorporated partnership, it also must register for corporate tax purposes, and this was now provided for with a deadline in FTA decision number 5 of 2025. If an application is made to be treated as an unincorporated partnership, i.e. fiscally transparent, the entity will not be subject to corporate tax in its own right. And this was discussed by my colleagues. But what does this mean for the beneficiaries? So firstly, let's look at the natural persons. Because it's an unincorporated partnership, it's transparent, they will not be required to register for corporate tax because it will be personal investment income or real estate investment income. The only caveat for this is if those natural persons are conducting business by themselves outside of the family foundation, and that business or business activity is conducted in the UAE. So just to reiterate, the natural persons will not need to register unless they are doing business or business activity on their own accord. And as my colleague Rida explained, the business and business activity must be in the UAE, and the total turnover from those businesses must exceed 1 million dirhams in the Gregorian calendar year. Any beneficiaries who are juridical persons, they are required to register for corporate tax because they're juridical persons. And for these, this will include qualifying public benefit entities. And to be a qualifying public benefit entity, you must register and apply to be a qualifying public benefit entity. Even if you are just a public benefit entity, you must register. We have a nice table here just to summarize this point. A juridical person that is a family foundation is required to register. A juridical person who is wholly owned and controlled by a family foundation is required to register. An unincorporated partnership that is already a family foundation is required to register. If you are a natural person that is a beneficiary of the family foundation, and that family foundation has successfully applied to be fiscally transparent, and it has no separate business or business activity in the UAE, which exceeds the 1 million dirham turnover, they are not required to register. If the beneficiaries of the family foundation are juridical persons, which includes a qualifying public benefit entity, they are required to register. Now the application to be treated as an unincorporated partnership. So, subject to meeting all the conditions, the juridical person can make an application to the FTA to be treated as an unincorporated partnership. And it must make the application before the end of the relevant tax period. There is an exception to this, and this is provided for in FTA decision number 5 of 2025, that if you make an application on or before the 31st of December 2025, the application can be effective from the commencement of any tax period ending on or before 31st of December 2025, as stipulated by yourselves in the application. And when submitting the application, you need to provide relevant information. This will be of how you're incorporated, the beneficiaries, and confirm that you meet the conditions. Just to reiterate the point on which being treated as fiscally transparent will apply. So it will apply to the tax period in which the application is made. It'll be one of the following that we see on the screen. So firstly, it will be the current tax period in which the application is submitted, or it will be the next tax period following the tax period during which the application is submitted. And then going back to my point previously, you can apply for a previous tax period, provided that the application is submitted in a tax period, is submitted before, on or before the 31st of December 2025. So we can show you this in the form of an example. Here, a family foundation has a fiscal year of the 1st of January to the 31st of December, and it made the application to be fiscally transparent in July 2025. Now, this application is before the 31st of December 2025, so it can choose to use any of the previous two tax periods in which it has. The first tax period being 1st of January 2024 to the 31st December 2024, or it can choose the 1st of January 2025 to the 31st December 2025. In the second example, the application is made in January 2026. So this is after the 31st December 2025. In this case, it will not be able to apply for it to be effective for the tax period in 2025. It will only have two options. Either the tax period in which the application is made, which is the 1st of January 2026 to the 31st of December 2026, so the current tax period, or for the tax period, the next tax period, which is the 1st of January 2027 to the 31st of December 2027. What does this mean for foreign entities? We spoke earlier that a foreign entity that is a foundation, trust, or similar entity can apply to be a family foundation in the UAE. So in this case, it needs to have a presence in the UAE to be determined as a family foundation. It needs to meet the relevant conditions under Article 17. And by doing so, it can make an application to the FTA to be treated as fiscally transparent. The FTA may request from foreign entities any information or documentation which will help with the application. This could be demonstrating that it is actually a foundation, trust, or similar entity under the legislation of the foreign jurisdiction. It may also need to demonstrate that the beneficiaries are natural persons, and if there is a public benefit entity, that it is a public benefit entity. If the application is made under Article 17 and it's approved by the FTA, it will be treated just the same as if it was a family foundation that was formed in the UAE. So there is no discrepancy the moment the application has been approved by the FTA. Moving on to the annual confirmation. So the annual confirmation there is to monitor the situation. It's continued compliance by the family foundation to be treated as fiscally transparent. The annual confirmation comes about after the application has been approved, and as the wording of annual suggests, it must be done on every single tax period, so every year. Because we discussed earlier that you can make an application prior to the 31st of December 2025 for earlier tax periods, there is also a caveat here that the annual confirmation must be done within 9 months from the end of your tax period. But if it relates to a tax period that ends on or before the 31st of March 2025, then for any of those tax periods, the deadline is 31st of December 2025. Again, this is provided for in FTA decision number 5 of 2025. My colleague Rida talked about multi-tier scenarios. So what does this mean for multi-tier scenarios? For the annual confirmation, this can be submitted by the Family Foundation itself, or it can be the Family Foundation submitting it on behalf of the juridical persons which are wholly owned and controlled by that Family Foundation. Alternatively, the annual confirmation can be made by each entity itself. And in terms of a family foundation which is already an unincorporated partnership, that unincorporated partnership must also submit an annual confirmation that it continues to meet all the conditions under Article 17. It can do this for itself and for the juridical persons wholly owned and controlled by the unincorporated partnership, or each entity itself can do this separately. So let's go through a quick example of this. Here we have a financial year of the 1st of April to the 31st of March. If the financial year is the 1st of April 2024 to the 31st of March 2025, the annual confirmation must be made on or before the 31st of December 2025. In the next year, which is the 1st of April 2025 to the 31st of March 2026, the second annual confirmation must be made on or before 31st of December 2026. In the second situation, we have a family foundation which has a financial year of the 1st of January to the 31st of December. The application was made in July 2025, so we could choose a tax period to which it commences anytime before the 31st of December. It chooses the 31st of January 2025 to the 31st of December 2025 as its first tax period. It therefore must submit its first annual confirmation before the 30th of September 2026. Thank you very much for the compliance side. I'll now pass over to Ruda, who will go through the Q&As.
Thank you so much, Siraj, Zubair, and Rida for the valuable information. We now move on to an important part of today's agenda. We will be gladly responding to your inquiries and questions about corporate tax. When registering for this workshop, many of you asked questions, and the team of experts will now answer most of the questions raised as I join them to the panel. So let's start with the first question, Rida. If my foundation meets the definition of family foundation and meets the conditions of Article 17 of the corporate tax law, will I be subject to tax or will I be exempt?
Thank you, Rhoda. So the question about family foundation is not about being subject to tax or being exempt from tax. The question is about meeting the requirement to be transparent. If you meet the requirement to be transparent, then the income, assets, liability, everything from the family foundation will be attributable in proportion to the ownership, in proportion of the ownership right to the beneficiaries of the family foundation. If they are natural person, then this will be attributable to them, and they will be considered to realize the income themselves. So the point is not about being exempt. The point is about meeting the condition to be transparent for corporate tax purposes.
Thank you so much, Rida. Suraj, how do I apply for a family foundation to be treated as an unincorporated partnerships?
Thanks, Ruda. So firstly, before you apply, you must register. That's the first most important point. Secondly, you go into Amara Tax, go towards the corporate tax section. There's a tile there that will say apply to be treated as an unincorporated partnership, and there is where you'll submit the application. Just remember that you can choose any tax period provided you submit the application prior to the 31st of December 2025. Subsequent to that, you can only apply for it to commence from the current tax period or the next tax period.
Thank you so much, Suraj. Zubair, if a family foundation undertakes some activities which constitute as a business, am I still able to make an application to be treated as an unincorporated partnerships?
Thank you, Ruda. So this was covered earlier in the conditions. Effectively, if you undertake activities, if a family foundation undertakes activities which constitute as business, fail to meet the condition, and therefore they cannot make an application to be treated as an unincorporated partnership.
Thank you, Zubair. Clear enough. Suraj, can a family foundation also be a qualifying free zone person?
So, thanks for that. These are different regimes. The qualifying free zone person, you're a juridical person, and provided you meet all the conditions because you're qualifying, you'll get 0% on your qualifying income. Whereas with a family foundation, you are treating yourself as fiscally transparent. So you are not taxed in itself, your beneficiaries, it looks through to your beneficiaries.
Thank you, Suraj. Zubair, could a foundation whose sole source of income is property rental income to be a family foundation?
Simply put, yes, it could be. The test, of course, as I mentioned in the last question I answered, is about business. If this falls within the scope of real estate and would be considered as real estate investment income, hands of the beneficiaries? The answer is yes. A foundation could, this is subject to meeting all the conditions under Article 17.1, but yes, a foundation whose sole source of income is property rental income could be a family foundation that's treated or apply to be treated as an unincorporated partnership.
Thank you, Zubair. Moving back to Suraj. Does a family foundation have to apply to be treated as an unincorporated partnership every year?
Thanks, Rida. As I showed earlier, you apply once. Once you apply and showing that you meet the conditions, the subsequent compliance is an annual confirmation. And you'll do this for each tax period going forward. So you only need to apply once.
Thank you, Suraj. Rida, where a family foundation wholly owns and controls several entities and applications have been made for these to be treated as fiscally transparent. What if the family foundation incorporates or acquires another entity in the future? Is it automatically transparent, and does it affect the existing structure?
Thank you, Ruda. So I think it's a very interesting question. So if a family foundation incorporates directly a new entity, if that entity meets the requirement to be considered as transparent, then it could apply to be treated as transparent, and then it will get transparency, regime. So it will be treated as an unincorporated partnership. If the entity is incorporated within the structure, so if we saw in the example of the multi-tier structure, down the structure under one of the entities, and if there are some entities underneath that entity, I think we need to make sure, if we want to get the transparency for all the entities owned directly or indirectly by the family foundation, we need to make sure that this entity also meets the requirement of Article 17.1. Otherwise, the entity owned directly by this entity will not be able to benefit from the regime, because we need to consider that always the entity that owns you is eligible for the unincorporated partnership regime. Otherwise, the subsidiaries or the entities underneath will not get the the benefit of Article 17.1.
Thank you so much, Rida, and thanks, Zubair and Suraj. Thank you, everyone. We would like to request you to open your giveaways, and you'll find a QR code to enable us to hear your thoughts and feedback about today's session. We tried to answer as much as question as possible. Please keep an eye on the FTA's dedicated page for corporate tax to hear about events and future workshops. You can also visit the FTA's website to get the latest update and contact us for any inquiries. Additionally, you can reach out to the call center or use the Contact Us page. We hope that this awareness workshop has helped answer your inquiries and provided a better understanding on the taxation of family foundations under the UAE corporate tax law. Thank you and have a lovely day.